Welcome to Uncorking Retirement, where we demystify your retirement portfolio and retirement plan. I'm Alex Newman, your host. I'm also the founder of Grape Wealth Management. So, how can you retire on less than $500,000? I get that question asked a lot. So today I'm going to walk you through specifically how a client retires with less than $500,000. As I always like to say, everybody's situation is different. And so it's important to keep that in mind as we walk through this scenario. So without further ado, let's dive into it. All right, so as you can see here, this is an actual financial plan for a current client. So in this scenario, over here to the top left, probability of success is 99%. Now, this is exactly where we want to be. There is no such thing as 100%. Obviously, there's a lot of variables when considering retirement, but that is as good as it gets. So that's a great sign. Now, I always like to say that anything above 70% is really where we want to be. In the event that it's below 70%, I highly recommend making some adjustments. So you'll want to make sure that you're in 75% or higher probability of successfully retiring without running out of money. So as we go over to the right, it shows their total net worth. So total net worth is $786,000. Now, keep in mind, net worth is simply assets minus liabilities. And so whatever your assets are minus any debts that you have equates to your net worth. If we go to the right, 9.9% effective tax rate, that is perfect. Obviously, the lower taxes that you're in, the much better your retirement's going to be over your retirement journey. So if we continue down and look at the balance sheet, this individual has about $40,000 in their bank accounts, about $370,000 in investable assets. So these are brokerage accounts or retirement accounts or IRAs. And then also a $500,000 property. So that's what the property is worth. But again, there is a liability, which is $129,000. So we take that $500,000 and we deduct $129,000 because there is that debt that's associated with it. So all in all, again, their total net worth $786,000. Now, with any retirement plan, it is so important that we have the proper allocation. And so what I mean by that is ultimately your stock to bond ratio. Now, the more stocks that you have in your portfolio over here, the more aggressive it is. The more bonds you have in your portfolio, the more conservative it is. So it's extremely important that you know how your portfolio is allocated. I can't tell you how many times that I met with a client and they say, hey, Alex, I'm conservative. I know I'm conservative. We pull up the portfolio and they have 100% stocks, which means that they have an extremely aggressive account. So that is something that we always want to look at. I recommend that you go through, you look at your portfolio and see how many stocks versus bonds or equities versus fixed income you have inside of your portfolio. Now, to the bottom left, we have the tax allocation summary. This is one of the most important pieces of retirement. Second to obviously income and then obviously allocation of the portfolio. But as you can see, taxable assets, $144,000 of their assets are taxable, and $230,000 are tax deferred. So like in IRAs or retirement accounts. All right. So as we continue through here, to look a little clearer or a little bit deeper into how we have this portfolio allocated, we want to make sure that we have the portfolio allocated not only properly from a stock to bond ratio, which keep in mind, guys, is a moderate portfolio. And so we also want to make sure, in addition to that, that we have the right sectors and that we're weighted properly. Now, obviously, the market is dynamic. Obviously, the market's going to change. There's going to be times like last year when energy did absolutely amazing. right? And then there's going to be other years, like this year, we're not so much. So it's important that your portfolio is constantly changing based on what's going on in the market. So as of right now, we have about 43% in US equities. We have some international equities. So stocks, again, some emerging markets like Brazil, things of that sort. Countries outside of the US, obviously. Also real estate. 2.3%. Right now, real estate is obviously an interesting environment just because rates are about 7% or so. And so that is an interesting sector, which I'm sure we'll be talking more about later from a market standpoint. But as we continue down, have a good portion of bonds, both US as well as international. So understanding your allocation inside of your portfolio is a very important step to making sure that you are going to be able to remain retired and not have to go back to work. All right, so as we continue here, as you can see, this is showing really two different options, current plan and proposed plan. Even though that shows 100%, as I always mention, I never 99% is what I tell my clients. There's nothing that says that 100% you're going to be okay. So it's important to make sure, again, that you're just double checking and triple checking your portfolio and how it's allocated. But the piece that I really want to show here is Social Security. So in this specific scenario, we are going to be saving this client over $155,000 over the course of their life, specifically on having a strategy for Social Security. If you have not looked into your Social Security, this is something that I recommend looking at. It's not one of those things that you just call and click the button and turn it on, right? You want to make sure that you're taking the proper strategy because you cannot go back and change that. So a benefit, just kind of a tip here, is that there are some options, such as if you have a spouse that you have been with for a certain period of time, and if they made more money than you over the long course of time, you may be able to get 50% of their Social Security benefits, which, by the way, does not impact them. So again, there's a lot of different routes and a lot of different options in regards to Social Security. So make sure that you're taking your time and really looking into that properly. Now, cash flows. So here, we're going to go year by year. So as you can see, this client currently is 53 years old, so hasn't retired quite yet. They have about $200,000 in taxable assets, $50,000 approximately in a current 401k, a little bit of Roth funds, and then about $200,000 in a traditional IRA. Now, one thing that I love here is that this client is also contributing to an HSA, or also known as a health savings account. This is very important because it is tax deferred, essentially, or it's before taxes, excuse me, and it certainly covers the inevitable. We will end up using these funds one of these days, right? So all in all, as you can see, first year based on a Monte Carlo analysis. So with all of our clients, we run Monte Carlo analysis, which just runs over 1,000 different probable results on what could possibly happen to their retirement portfolio. And so it spits out these numbers, and it just at least gives us a range or a decent estimate on how the account's going to look at the end of each year. So as you can see, first year, about $450,000 by the end of this year. Next year, 44, 522, so on and so forth. And at the very end of their plan, once they get to 90 years old, which is 2060, this portfolio should be worth about $2 million. And so that is the beauty of compounding interest. Also the reality of inflation, right? Now, something to keep in mind is, as you can see in here, we are working on what's called a a Roth conversion strategy, which means that as this individual gets older and starts retirement and drops down to a lower tax bracket, then we start converting some of their traditional, so pre-tax money, we start converting it into an after-tax bucket. Now, I know what you're thinking, Alex, why would you do that? Why would you want to pay taxes early? And the reason being is because we want to make sure that that money could grow as much as possible. And so later on down the road, when you go to take out those funds, it is no longer taxable. And so all of that growth that you experienced after converting it to Roth is completely tax-free. And so that means a lot, especially over a longer period of time. If you write down anything in this video, write down Roth conversion. I have seen it save hundreds of thousands of dollars of money for clients over the period of their life. All right, so outside of that, if you don't have an estate plan, we always recommend an estate plan. Obviously, depending on your assets, it could be more imperative than others, but for all of our clients, we provide an estate plan. So if you would like to figure out how you could get an estate plan, I will go ahead and put the link in the bottom in the description, and we'll be more than happy to have this conversation with you, as well as, of course, making sure that your retirement is in order and in line. All right, so looking at the estate flow chart, as you could see, by the time they pass away, their total net worth will be about $4.2 million. Now, again, I know that sounds like a lot of money, but something to keep in mind is inflation. This is including not only their expected to be $2 million retirement portfolio, but it's also it's taking into account the property at that time. So nonetheless, once they pass away, as you can see, there's about $4 million going to heirs. We automatically account for potential probate and then also funeral expenses. But other than that, guys, as you can see here, in this specific scenario, they will be able to retire with under $500,000 in investable assets. And I have no doubt that this client, I have complete confidence that this client's going to be okay, specifically with some of the strategies that we use, such as a Roth conversion strategy, really helping to maximize their returns, as well as implementing a strategy to maximize Social Security and reduce taxes as much as possible. So other than that, leave your comments below. If you have any questions, feel free to reach out. I will get back to you immediately. All right, talk to you soon.